Sales returns and allowances. Why do we need separate accounts for sales returns and allowances? Let's assume that the business sold goods to customer A for $5,000. Customer A paid in cash. Cash is debited and sales revenue is credited for $5,000. The business sold goods to customer B for $20,000 on account. Account receivable is debited and sales revenue is credited for $20,000. The business then sold goods to customer C for $75,000 on account. Account receivables is debited and the sales revenue is credited for $75,000. The sales revenue account has a balance of $100,000. If an income statement is prepared at this point in time, the statement will show a sales revenue of $100,000. Let's now assume that customer C returned back $60,000 worth of goods as they are of bad quality. If the company debits the sales revenue account and credits the account receivable for $60,000, the balance of the sales revenue account will be $40,000. The income statement will show sales revenue of $40,000 as well. The reader of the income statement will think that the $40,000 are all of the business sales. But the reader won't know that there were sales returns. Alternatively, the business could use a contra sales account, which is sales returns account. This account has a debit balance and hence it is subtracted from the sales revenue account in the income statement. So when customer C returns the goods, sales returns account is debited and account receivable is credited by $60,000. Remember that the sales revenue account is not affected in this case, and it has a balance of $100,000 still. It will appear in the income statement as $100,000. Then the balance of sales returns account, which is $60,000, is subtracted from it to get the net sales of $40,000. Now, the reader of the income statement will realize that there is a problem since 60% of the sales were returned. So using the sales revenue account to account for both sales and sales returns will hide the sales returns and it won't be visible to the readers, which goes against the principle of accounting disclosures. Using two accounts, one to account for sales revenue and another one for sales returns, will result in more disclosure to the readers of the financial statements. Besides sales returns, sales allowance also reduce sales revenue. So, what are sales allowances? Let's assume that the business sold the computer to a customer for $1,000. The customer discovered that there is a minor scratch on the side of the computer. The manager of the business gave the customer a 30% discount on the computer instead of taking the computer back. The customer agreed and accepted the reduction of $300. This would be called an allowance, to give the customer a credit for a minor defect or something similar. Did you notice the difference between sales returns and allowances? In sales returns, the business receives the good back. In sales allowances, the business does not take the goods back, but instead grant an allowance to the customer. The business debits sales allowances and credit accounts receivable. Notice that sales allowances is also a contra sales revenue account, just as sales returns. That is why many companies would merge both accounts together into one account, which is called sales returns and allowances.